Hello and a very warm welcome to Policy Watch, our weekly program in which we bring you abreast of all the main economic developments in the week just ending. This week we will be discussing the fall of the rupee, the very dramatic fall of the rupee in fact, the RBI's mid-quarter monetary policy review and the just released report of the world's wealthy or the HNIs. And as always, we have with us an expert, Subhomoy Bhattacharjee, Deputy Editor, The Indian Express, to take us through these developments. Welcome to the show, Subhomoy. Over the past few weeks, to be more precise, from mid-May this year, the rupee has been on a downward path vis-a-vis the dollar, depreciating by almost 10% in a little over a month. On Thursday, it briefly touched a record intraday low of 60 rupees to the dollar before recovering to close at 59.58 on intervention by the Reserve Bank of India. Friday was just a little bit better. Though the rupee opened weaker at 59.69, it improved during the day and did not test the lows seen on Thursday. How long will this phase continue? Are we headed for better times? We'll go into all this with our expert. But first, let's hear a report from our bureau.
The rupee continued its decline against the dollar owing to heavy demand from importers and banks. The rupee depreciated by 130 paise during early morning trade. However, it recovered marginally during the day to close at 59.57 a dollar, down by almost 1.5%. Concerned by the development, the government announced its willingness to act to curb the volatility of the rupee but ruled out immediate intervention.
The Finance Ministry, the RBI and SEBI are watching developments closely and will take action as appropriate. We are not, let me emphasize, we are not short of actions and instruments if and when the need arises.
The US Central Bank's announcement of its intention to withdraw its monetary stimulus by the year-end led to the strengthening of the dollar against major currencies.
The government policy is that we are not fixing an exchange rate. We are allowing the exchange rate to move with the market, and the Reserve Bank intervenes when it feels that there's too much speculative pressure.
The gap between inflows and outflows of the foreign currency is expected to be 5% of the GDP or nearly $200 billion this fiscal. It swelled to more than $20 billion in May from nearly $18 billion a month ago. India imported gold and silver worth $8.4 billion in May, increasing pressure on the already weak currency. With Krishnanand Tripathi, Bureau Inputs, Rajya Sabha TV.
Subhomoy, we just heard that report where we heard Raghuram Rajan saying we're not short of firepower. What is this firepower we're talking about? We've seen the rupee sinking. How much further will it sink before the government finally acts?
Yeah, that's a good point. I mean, how much further will it sink? Mythili, you've got a very good guess, and you've been tracking the rupee for ages, the forex market. But before going to that, let's look at what are the instruments that a government says when it has. The instruments actually, despite the brave words by the chief economic advisor, are very few. You essentially either buy sell dollars in the market, or else what you do is you put in quantitative restrictions. Now, when you're trying to put in quantitative restrictions, you immediately create a one-way hedge for the people who want to bet against the rupee. So it's definitely something which will continue as long as the Reserve Bank has the power to hold that hedge. So it's obviously a street that we can't go down. So the other thing is to selectively sell the dollar as and when the rupee turns to be volatile, as the Planning Commission Deputy Chairman Montek Singh Ahluwalia said. So essentially, we have to have only that. The other option that we had, which we had used some years ago, was what we used what is called the Monetary Stabilization Fund, which was the bond which the government bought and sold in the market. But the scope for that is limited by the fact that we have got a fiscal deficit which is fairly high, a current account deficit which is high, and now if we try to bring in that sort of an instrument in the market to try to mop up dollars, the problem would be that this will be seen as a sort of soft addition to the fiscal deficit, which will be quite dicey. So, the range of instruments frankly are very limited.
Is very limited, particularly because on Thursday the rupee recovered partly and on Friday did not go down so much because the RBI was intervening, as you said, in the market to sell dollars. But given the fact that our forex reserves are not so much, roughly 290 billion, and that's just enough to cover 7 months of imports, how much can the RBI sell? That's my first question.
Yes,
and my
exactly.
second question really is that cannot the government think in terms, we had NRIs coming to our rescue in the past, India Development Bonds, Resurgent India Bonds, Millennium Indian Bonds. Why doesn't the government act now instead of waiting for the horse to bolt?
A very good point. In fact, even of the 290, if you leave out the gold amount, that's about $260 billion, which is basically the foreign exchange reserves that we hold. Of this 260, about 110 or 112 is about the stock of the FII flow, which you essentially don't want to get into. So that leaves us about 110 or $120, $120 billion that we essentially have. Now, yes, it might seem a good idea to go out in the market and to float a bond and to mop up money. But for that, first of all, RBI will have to keep the interest rates high. Second, a float of this sort, after having said repeatedly that we don't want to go in for a float, now asking the market to give us could create a position where we would be having to give a very wide headroom over the LIBOR to be able to attract. And if that money doesn't come through, in the sense that if the thing is not adequately subscribed to, then that could be adding to severe pressure. So I suppose the options really are to sort of hunker down and to see that the economy starts moving, the current account deficit starts looking better, and essentially to sort of ride out the storm. If you can ride out the sharpness, by September, Bernanke says that he wants to bring in the start pulling down from the $85 billion monthly sales that has been done. If the rupee can sort of go it through, there is an amount of pain that will happen, that the rupee will be basically going down. But if we can get that pain through and yet ride it out, I think it will be better for the Indian economy rather than bringing in very short-term measures that could have much more demanding impact on the economy.
See, the worry about the weakening rupee is not only because of the weakness of the rupee per se, but also because you have imported inflation. When oil imports become more expensive and all your imported items become more expensive, inflation, which we had very slowly, very gradually managed to get down, not to a respectable number, but at least in single digits, that may again shoot up. So we have worries about inflation as well. So how does one tackle this?
Exactly. And our tradable, if you look at that, our amount of tradable, that's pretty high. So there is a problem there. But at the same time, what's happening is that the Indian economy right now is not importing at a level where it would have done had it been growing at a higher rate of growth.
Absolutely.
Now, this is actually a bit of a chicken and egg situation. If we had a better growth rate, probably the rupee would not have bucked up like a bucking bronco and would have done better. But at the same time, the very fact that we are slowed down, the imports are slower, is probably giving chance that the import bill will not be very high. The auto sector isn't really pushing hard, so the demand for oils is to some extent limited. Of course, auto demand is only about 8% of the total oil bill. So give and take, it is a question of feeling as you go along, and I don't think at this stage we can take in anything more than what is currently there. Imported inflation, I wouldn't be very scared because the global inflation is pretty, even now, even though the thresholds have been raised across each country, it's still pretty limited. So possibly we could afford to ride it. Some of the big ticket investment plans, like the Japan aided DMIC, if the flows from there start rising in, that could be a very interesting flow. The projects and others are fairly ready. If the government starts really pushing those, and those are substantial amount, if those start coming in, then probably we could see a fairly decent change in the prospects for the rupee.
Yeah, sure, because I think towards the end of this month, we are expecting roughly a little over 5 billion to come in from the Unilever offer
right.
to buy back their shares. So then that might help. But these are all temporary solutions. Do you think we could follow the Malaysia experiment during the Asian crisis and impose capital controls? It made Malaysia a pariah in the international markets for a while, but it did ensure that Malaysia, in fact, came out better through the Asian crisis than many of the other Southeast Asian tigers. Why is the government so hesitant? You get a bad name for a while, but memories are short and people forget. At least it's better than the rupee going to say 62, 63, which is what a senior official from Credit Suisse has predicted today. He says within a year, the rupee will be somewhere near 62 to the dollar, and that would really be quite catastrophic. So can one think of capital controls?
It is, I mean, 62, I mean, even 60 we were supposed to reach by the end of this year, and we've already hit 60 in middle of June. So 62 might be coming faster. But yes, capital controls I'm not very comfortable with, for the simple reason that once you do that, you essentially are setting yourself up against a sort of a tide where the flow, where you're saying that I will sort of, determine that how much capital goes out. Now, first of all, anybody India's got a huge amount of FI investment. Anybody who's got a very short-term horizon will immediately pull out.
Absolutely.
That's the first thing that will happen. Even for FDI, I mean, FDI and FI, the difference is actually very thin. And anybody who's got a horizon which is less than 1 year could start wondering that, I mean, I need to go out before the, the bulwark comes in. Thailand, I remember the morning they announced, by afternoon, half the treasury was empty. So these are serious questions. India has never done capital controls post-liberalization. And for an economy of the size of India, for the reputation that's built up, if we try to do that sort of stuff...
Not a happy solution, I'm afraid. I agree with you entirely, but right now I think we'll have to interrupt you, Subhomoy, because we'll go into a short break. But please stay with us. We will be with you after a very short break. The Reserve Bank of India kept key policy rates unchanged in the Monetary Policy Review earlier this week. Industry was hoping for a rate cut, but the central bank decided not to tinker with the rates because of high food inflation.
Reserve Bank Governor D. Subbarao has a difficult task of boosting investment while keeping the inflation under control. High food inflation coupled with a weak rupee and global uncertainties compelled him to maintain the short-term lending rates unchanged despite demand for a rate cut from the industry. The Reserve Bank maintained the lending rates unchanged. It also did not tinker with the cash reserve ratio, which was kept unchanged at 4%. Industry was hopeful that the Reserve Bank would not wait until July for a rate cut, as the factory output grew by just 2.3% in April. However, high prices of cereals and other food items forced the central bank to keep rates unchanged to stop further spurts in food prices. Bureau Report, Rajasabha TV.
Subhomoy, we just heard a little bit about the RBI's monetary policy review. What, in your view, was, is the RBI's reading of the situation? Why did they keep rates unchanged? Is it because the RBI is chicken, or in hindsight, was it wise given what's happened to the rupee?
Yeah, in hindsight, it does seem a bit of a good call this time. Essentially, which is not to say that RBI doesn't take good calls, but at least this time, given the fact that the rupee, where it's moving, pushing down interest rate, first of all, first impact would have been on the NRI deposits in dollar, which is the FCNRB. So those would have been the first ones affected. But that is one of the issues. But the other issue is that the essential thrust of the management of the economy has now inevitably shifted to the fiscal policy things. And there, RBI changing rates, and especially repo rates, will not really make a substantial impact. A CRR rate cut, yes, it could have an impact, as Pradeep Chaudhary has said, because that immediately brings in idle cash reserves into the banking system. But that's a call, that's a larger call. But in terms of repo rate cut, how much would it translate into, consumer's pocket is very limited. It's just, SBI estimates it's just about 50 crore rupees, which they have to spread among their depositors, which that's really nothing. The other thing that's happening is, if Mythili, you would have seen yesterday's release of the consumer behavior, the monthly consumption expenditure. And the interesting thing that I can see there is that the non-food expenditure of the Indian economy is rising. So there is a certain amount of inflation, what you might call which is being built
bias.
into the bias, built into the economy. And that is something which RBI will have to sort of factor in.
Apart from which, I think one of the factors that influenced the RBI was that if you push interest rates down, you're likely to add to demand pressures. And at a time when you're trying to get the current account deficit under control, you don't want to add to any kind of demand pressures. Apart from which, I think whatever portfolio investment we were seeing in the past was because of this differential between, the interest rates in India and the interest rates abroad. And given the fact that the way the dollar has been strengthening, you didn't want to take a chance, especially because in the US, 10-year treasury bills, the yield has been going up. So almost anybody would think, why take the exchange risk and invest in India? And why not invest in the US instead? So the RBI, I think, perhaps decided to bide its time. But industry is kind of pretty certain, or is kind of putting a lot of pressure, that at least in July, you must reduce the interest rates. Would there be a case for that?
Well, I suppose, if for this year, there is always an implicit assumption that the rates would come off by at least 100 to 150 basis point. So given that there's only been a 25 basis point at the beginning of the year, so I would expect July to be a good time. And that will also give them a chance to look at today the Kharif output data would be coming along. So they would have some indication of which way the combination of the food economy is looking at. 1 month's more industrial figures to show whether the economy is. So yeah, definitely there is a possibility that you have got a better set of data to tell you that which way it is coming along. Though I'm not very sure whether the interest rate cut would really translate into immediate impact on industry output.
Absolutely, which is what the Reserve Bank has been saying. They've been saying for a long time that, look, we've played our role, now the ball is in the government's court. And the government has made some measures, taken some measures in terms of the FDI in retail, announcing like oil deregulation, etc. Has the government done enough, or is there more that the government should do? And will the RBI keep waiting for the government to do something? Remember, we have elections coming up, so the government is going to be spending more and more as elections approach. So is the ball in the government's court still? Has the government done all it could? Or is the Reserve Bank just saying, look, we wash our hands off this, it's your baby now?
Well, there are two things there. First of all, the buying of the gold itself showed that there's a flight of capital from the economy. So essentially, that is something that any governor would be very concerned about, that investors were showing that they were not comfortable with the rupee. So that was very good reason to keep the interest rates high. The second thing that's happening is that this year, the government is moving majorly on direct benefit transfer, and that means a huge amount of monetization of the economy as such, an additional amount of cash that will be coming into the economy. Willy-nilly, this amount will add to the pressure on prices all around. We had one pressure round coming from NREGA. This is the another round that will come. And this is a very, very major impact about which we don't know how they will turn out.
So the RBI has been wisely cautious. So on that note, we'll take a short break once again. But please stay with us. We will be back in a moment or two. Well, it's not all bad news. Amidst all the bad news on the economic front, the week also brought some good news, at least for some. According to the World Wealth Report 2013, released by Capgemini and RBC Wealth Management, the investable wealth of the world's HNIs, that is high net worth individuals, after declining 1.7% in 2011, rebounded in 2012 to reach a record high of US dollars 46.2 trillion. As many as 1 million individuals joined the global population of high net worth individuals, taking the total number to 12 million. India too saw an increase in the number of the uber wealthy, or HNIs, those whose net wealth in terms of financial assets is 1 million or more. The number of millionaires in the country grew 22.2% last year, clocking the highest growth after Hong Kong. The growth in the number of HNIs in India is attributed to positive trends in the equity market, capitalization, gross national income, consumption and real estate. Well, Subhomoy, you and I think, are not in that 22.2%, right?
Just expecting that you'd say that we have figured.
Anyway, but what is your take? Is it good news really that we have, shown second highest after Hong Kong, the number of, should we be celebrating, or should we also be bemoaning the fact that almost a day after that, we've heard this report in the papers today that the average expenditure in the rural areas is only about 17 rupees a day. So should we be celebrating that the number of, some of our countrymen are so rich, you and I may not be there, but some of our countrymen are so rich, or should we be bemoaning the fact that we have 153,000 Indians who are part of this group, even as the rest of us may be left far behind? What should we be doing, celebrating or mourning?
Yeah, I suppose it's just a call for Mr. Chidambaram to start looking at his numbers and to say, well, I mean, where are these people? I mean, why aren't they figuring
Paying
my
their
tax?
taxes.
Exactly. I mean, because the numbers are definitely far higher than the numbers that are thrown up by the tax numbers. So obviously, that the first thing that you feel like checking out that what's happening. Then the tax department isn't really looking at these numbers carefully. Other than that, I think I don't think the fact that people are poor and these people who are rich, it's really sort of related in that way, in a sense that the Gini coefficient in India isn't really particularly worsening drastically.
That's partly because I think the data is not very correct, because if you look around, at least visibly, anecdotally, certainly inequalities have risen, at least visible inequalities. And we are seeing the offshoot of that in the rising red belt in central India. If inequalities grow, as they certainly seem to have done, though the Gini coefficient does not reflect that, then you are going to have much more unhappiness. And in a democracy, can you really afford to have widening inequalities?
Yeah, that's a good point. But Mythili, my point is that if inequality is at one level is something that is worth addressing. But my bigger problem is that the absolute level, which you talked about, the 17 rupee, that is not something that is a factor of the Gini coefficient. That's simply a question of those people not getting adequate income. And that can generally be pushed up. And that can be pushed up by a combination of very many factors, which doesn't necessarily address the issue of inequality. It is simply a question of ensuring that there is an adequate income possibility at the bottom of the pyramid.
So if there is growth, you're saying everybody improves, the rich as well as the poor.
Yeah.
So on that note, I think we will have to come to the end of this program, and we just give you a key takeaways from this program, I think, on all the three issues that we discussed today. Subhomoy agreed with me as far as the rupee is concerned, that things are not too hunky-dory, the rupee is weak, the economy is weak, and had the economy performed better, maybe the rupee would not be in the predicament that it is now. As far as the RBI's mid-quarter review is concerned, Subhomoy and I also perhaps to some extent agree that the RBI has done right. It's called its card right, because you do need to concern about inflation still. We have not really whipped the inflation horse as yet. As far as HNIs is concerned, Subhomoy has a slightly more tolerant view of the large number of HNIs who are obviously not paying the taxes they should. But on that note, I think we will come to the end of this program. But please do stay with us. We will be with you once again. Thank you very much for watching.